Exercise 3.9. You are provided with information relating to Naval Tennis Shop, a business that sells tennis rackets and tennis balls. The periodic inventory system is in use. Required 3.9.1, refer to information 1, explain shortly what is applicable for the owner to use the FIFO method for tennis rackets and the weighted average method for tennis balls. 3.9.2, calculate the value of the closing stock for the two inventory items. Tennis rackets use the FIFO method, tennis balls use the weighted average method. 3.9.3, calculate the following for tennis rackets, round to 2 decimal places. Cost of sales, gross profit, VAT charged for clients on tennis rackets sold, and profit margin percentage. Information 1, inventory valuation at the beginning and the end of the accounting period. Information 2, delivery fees, exchange rates, and custom duties. 2.1, tennis rackets are manufactured in China but are acquired from a local supplier who is responsible for the import of the rackets. Delivery cost amounts to 80 Rand per racket. Delivery cost is included in the opening stock of 900 Rand per unit. 2.2, tennis balls are imported from the USA. The prices are quoted in US dollars. The exchange rate was 13 Rand 20 for $1 US throughout the year. Custom duty is levied at 12% of the Rand value of the purchases. Delivery fees are paid by the manufacturer. The custom duty charge is already included in the opening stock figure of 9 Rand 32. In 3, purchases during the year is given for your tennis rackets and your tennis balls. And 4, sales during the year, including that. Your sales for tennis rackets, 169 units at 1,656 Rand each, to give you 279,864 Rand. And your tennis balls, 21,752 units at 15 Rand 96 each, to give you 347,162 Rand. 3.9.1, refer to information 1. Explain shortly what is applicable for the owner to use the FIFO method for tennis rackets and the weighted average method for tennis balls. Well, tennis rackets are more expensive items of which not great numbers are sold. The price varies between purchases and it is quite easy to keep track of the movement of stock. Tennis balls are cheaper items of large quantities that are sold. It is difficult to keep track of exactly which balls were bought and sold at which specific time. 3.9.2, calculate the value of closing stock for the two inventory items. So remember, the tennis rackets use the FIFO method to calculate the closing stock. So firstly, we need to calculate the number of units on hand. Now to do that, it's going to be our opening units plus our units purchased minus our units sold. So if we go back to the information, our opening unit is 18 units. We purchased 170 units during the year and we sold 169 units. So in other words, 19 units will be our closing stock. So because it's a FIFO method, if we go back to information 3, the first 15 units will be at 875 Rand, and then we'll have 4 units at 860 Rand. But remember, in information 2.1, delivery cost of 80 Rand per tennis racket is also involved. So then it's going to be the 875 plus the 80 Rand per unit for delivery costs as well. And then that gives you 18,085 Rand. For the tennis balls, we use the weighted average method. So firstly, we must calculate the closing units on hand. Now to do that, remember, it's your opening units plus your units that you purchased minus your units that you sold. So if we go back to the information, it is going to be 4,152 units at the beginning plus the 19,800 units that we purchased minus the 21,752 units that we sold. So our closing units on hand will be 2,200 units. Then to calculate the weighted average price, it's your opening stock value in Rand plus your purchases in Rand plus your custom duties in rand value. Divide by the opening plus purchased units. And then we times by the units on hand, which was the 2,200 units we've just calculated. Okay, our purchases, because it's in US dollars, we first need to do a calculation for our purchases. So it's going to be 10,750 US dollars at 13 rand 20 to give you 141,900 rand as our purchases. And our custom duties, they said it's 12% of our purchases, which will be 17,028 rand. So then to complete the calculation, our opening stock is 38,676 rand. Our purchases is 141,900 that we just calculated, and our custom duties is the 17,028 rand that we've just calculated. We divide that by our opening stock and closing stock units to get 8 rand 25 cents per unit. We times that with 2,200 units that's on hand to get 18,150 rand. 3.9.3. Calculate the following for tennis rackets, round off to 2 decimal places. Firstly, we need to calculate the cost of sales. Now remember, to calculate our cost of sales, it's our opening stock plus our purchases plus any delivery costs, is in this case in this question, and minus our closing stock. So if we work out the delivery cost, we purchased 170 units during the year and we pay 80 rand per unit. So our delivery cost will be 170 units times 80 rand, which is 13,600 rand. Then to complete and calculate the cost of sales, our opening stock is 16,200 rand. Our purchases is 144,605 rand. The delivery cost just calculated is 13,600, and then we minus our closing stock of 18,085 rand that we calculated in 3.9.2, and then that gives us our cost of sales of 156,320. Then to calculate the gross profit, remember it's your sales minus your cost of sales. Now if we go back to the question, our sales was 279,864 rand, but it included VAT. So we need to work out the price excluding VAT. So to do that, we are going to times 100 and divide by 115 to give you 243,360 rand as our sales. So then if we take the 243,360 rand and we minus our cost of sales of 156,320 calculated above, our gross profit is then 87,040 rand. The VAT charge for clients on tennis rackets, so they said it's VAT inclusive, so if the amount includes VAT, it's 15 over 115. So our selling price is 279,864. We times by 15 divide by 115. So our VAT is 36,504 rand. Then the profit margin percentage, to calculate that, it's your gross profit divided by your cost of sales times 100 over 1. So if we do the calculation, our gross profit is 87,040 rand. We divide by our cost of sales of 156,320. We times by 100 over 1 to get a percentage, and then we get 55.7% on cost price. Exercise 3.10. Tabu is the owner of Tabu TVs. He sells different sorts of TV sets. He uses the periodic inventory system and the specific identification method to value his trading stock. The financial year ends 28 February 2025. Required. 3.10.1, we're going to explain the difference between the periodic inventory system and the perpetual inventory system. 3.10.2, we're going to calculate the following for February 2025. The value of the closing stock according to specific identification method, the cost of sales, the gross profits, and the profit percentage maintained on cost price. And then for 3.10.3, Tabo wants to change from the specific identification method to the weighted average method. What advice would you give him? And provide 2 points. Information 1, the following records of TV sets appear in the books of Tabo's TVs, and then they give us the opening stock and the purchase dates. 2 returns, 5 faulty BX3 TVs purchased on 50 June 2024 were returned to the supplier. And 3 sales, the business sells TVs at a fixed sales price of 9,400 Rand per TV. 3.10.1 Explain the difference between the periodic inventory system and the perpetual inventory system. Well, the periodic inventory system, cost of sales only calculated at the end of the year. The purchases account is in use, and it's difficult to determine stock losses or theft of inventory. For the perpetual inventory system, cost of sales is calculated continuously during the year. A cost of sales account is in use, and theft of inventory and stock losses can be determined easier and more quickly. 3.10.2 Calculate the following on 28 February 2025. The value of the closing stock according to the specific identification method. So if we go to information 1, we first need to calculate the cost price per unit for our opening stock. So we know that we had a total of 744,000 Rand and we purchased 120 units. So 744,000 Rand divided by 120 will give you 6,200 Rand per unit. So now we've got the unit price for our opening stock as well as all our purchases for our different TVs. Then we work out the difference between purchased and sold. So for the opening stock we had 120 purchased, we sold 110, so there will be 10 TVs. For 15 June's purchases, it will be 140 minus 110, which is 30. For August, okay, and then also on number 2 for 15 June, 5 faulty TVs was returned. So out of the 30 we minus another 5, so it's only 25 units for 15 June. For 30 June it will be 150 purchased minus 120 sold, which is 30 units. And for 25 October it will be 60 purchased minus 45 sold, which is 15 units. So then to calculate the closing stock, it will be the 62,000 from the opening stock, 120,000 from 15 June's purchases, 183,000 from 20 August purchases, and 78,000 from 25 October's purchases. And that gives us 443,000 Rand. Then to calculate the cost of sales, it's going to be our opening stock plus our purchases minus our returns and minus our closing stock. Remember the returns was on 15 June. 5 TVs were returned with a cost price of 4,800 Rand. So 24,000 Rand will need to be subtracted. Okay, so if we calculate our cost of sales, it's the 744,000 opening stock plus our purchases of 1,899,000 minus our 24,000 returns and minus the closing stock that we've just calculated of 443,000 Rand to give you 2,176,000 Rand. To calculate the gross profit, it's our sales minus our cost of sales. Firstly, we need to calculate the sales amount. Now remember, we sold 385 units at 9,400 Rand per unit. If we do the calculation, then it amounts to 3,619,000 Rand. We calculated the 385 units by adding our opening stock of 110 TVs sold plus our purchases of 275 TVs to give you 385 units at 9,400 Rand per unit is 3,619,000 Rand. So the gross profit will be our sales minus our cost of sales. So the sales is 3,619,000 minus the cost of sales that we've just calculated is 2,176,000, and then that will give us an answer of 1,443,000 rand. The profit margin percentage maintained on cost price. Okay, to calculate that, it's going to be your gross profit divided by the cost of sales times 100/1. So the calculation will be as follows. It's the 1,443,000 if we've calculated as our gross profit. We divide by our cost of sales of 2,176,000 and we times by 100/1 to get a percentage. And then our gross profit margin is 66.3% on cost. 3.10.3, Thabo wants to change from the specific identification method to the weighted average method. What advice would you give to him? Provide 2 points. The weighted average method is not suitable for individual TVs with a high value and unique features. It is unethical to change the method only to manipulate figures and profitability. A change in the valuation method must be submitted to SARS for approval to make it valid.